traders overcomplicate everything. Too much analysis, too many indicators leading to too much second guessing. But what if I told you that the best trades often come from the simplest setups? This one strategy here made Carmine Rosado $56,437 without anything overly complicated at all. Let's see how keeping it simple can make you more money.
I made a gross profit of $25,000. And yesterday on February 12th, I made a gross profit of $30,000. And in this video, I want to break down my thought process. I want to break down my risk. I want to break down why I entered, why I exited, my confirmations. And I just want to go over my levels, how I developed them, so you can understand what was in my head at the time of execution and how I came up with these scenarios and plans. Now, if you're new to my channel.
All right, so there you have it. 56K profit in 2 days. We've got the full recap and strategy breakdown. We're going to map this out with trade number 1, every single detail, trade 2, every single detail, and then analysis and strategy. Let's get into it.
But now let's get right into this recap. Now let's first talk about the trade on Wednesday, February 12th. I traded 30 ES future contracts. My risk was $4,500. And my risk to reward was about a 7-to-1, which means $4,500 worth of risk for about a $31,000 profit. Now, for this trade to make sense, let's go step by step in my analysis and in my plan. The first thing that we have to be aware of is the market had CPI data at 8:30 a.m. Eastern Time, about an hour before the market opened up. It's very important to be aware of major economic data, major economic news such as CPI, FOMC, PPI data, job reports. Usually high impact news affects the market, and I find it provides high quality trading setups. Now, on this 8:30 news, the market aggressively dropped about 70 or so points.
Okay, so if you're not familiar, if you're new to trading, then this might sound unfamiliar, but this is financial juice. So if you're wanting to make sure that you're not trading when there's major financial news, just go to financialjuice.com. It's a free resource that I can recommend you that I use, and it'll tell you if there's anything major happening. And what you want to look for are the big red buttons, okay? So the big red buttons will tell you if something that day is likely to affect your trading. And then what you can do is either trade around that or just stay out until the market stabilizes. Again, it's financialjuice.com, and that's the best way to do this. Now, notice that the trading price action here was pretty much sideways coming into the day, right? This was probably overnight, most likely. And then this is when that report drops. CPI is Consumer Price Index, okay? This is one of the biggest numbers that affects all financial markets, okay? So as soon as that price came out, then you saw this huge bear breakout, okay? So you don't want to be trading when this is happening, but you want to know that this is going to happen so you can anticipate it. And for that, just use Financial Juice. Now, what's good about this is it's going to send ripples throughout the market. So once this happens, we can watch how the market reacts to some huge move like this and then get in once it's picked a direction.
Now, in this very large red candle to the downside, what's significant to note here is pulling up a volume profile. If these terms are new to you, I would highly recommend checking out my order flow series. But during this very large drop where the market moved down at 8:30, we left an area where there was very little to zero volume transacted, starting at 60.60 all the way up to 60.75 where the volume began to transact at a much higher price. So on this drop, there was significant selling activity because the market didn't give a chance to really transact there at 60.60 to 60.75, and this was the basis to this trade today. Now, the reason why this is so important, and I introduced my target first, is because these levels where there's very little to no volume trading around, the market tends to gravitate towards them. The reason for this is because the market, what caused this large drop was an unfair chance, or for other participants didn't get a shot at really transacting here because there was no volume there. Now, the market likes to gravitate towards this to give other participants a chance to trade. Now the market opens up, and right out the gate in the first 30 minutes or so, we have just a really, really strong rally to the upside.
Okay, great. So let's make sure that we're following here. On trade one, which is what we're in right now, you can see if we look at his details of the trade, he went in with 30 ES futures contracts. Now, if he didn't mention that, he's going to, and he risked $4,500 and was looking at a risk to reward ratio of 7-to-1. That means if he's risking $4,500, a 7-to-1 would be looking at about 31,000 profit. Now, what I want to outline here is that he is predefining his risk before he enters the trade. Do you predefine your risk before entering every trade? If you don't, that's a must. The professionals in this game predefine their risk before entering, and he is doing that. And then he's looking for a 7-to-1 risk to reward ratio, which is absolutely incredible. Now, if I told you that I was going to give you the potential of making $700 every time you gave me $100, how often would you make that trade? I'd say pretty often, right?
Since the market had this very strong rally to the upside and missed the level of resistance at 60.60, my thought process was to look for a pullback or look for an area where I can take the market long, speculating that this target at 60.60 will trade. Now, in very strong uptrending moves or even downtrending moves, I like marking out areas where the market consolidated or based, followed by continuation up or down. So around this 60.40 level is where the market consolidated. We moved up over here, we consolidated in this range, and then we had continuation up, missing our target by about 6 points.
And if we're trying to keep this simple, right? If you're new to trading and you're like, what does it mean that it consolidated here? What you can look for are what are called doji candles. A doji candle is a candle with the tail on the top and the bottom. Now notice, we don't have many doji candles here. We have one here. There's a tail on the top and the bottom there. We have one here. There's a tail on the top and the bottom here. But we're still moving higher, right? So this is just a pause and then another move higher. And we're still moving higher. It wasn't until we went sideways here. Now, consolidation means sideways, okay? We went sideways for one candle here, and we went sideways for one candle here. But it wasn't until here that we went sideways 1, 2, 3 different times, okay? So this is our first area of consolidation. And all he's saying is once we're breaking out to the upside and in an uptrend, he wants to mark out where the price consolidated, because then he's going to see that as an area of an interest for a pullback entry. And a pullback entry is just when the market's in an uptrend and it retraces and comes back down, we're going to try and get back in to that uptrend for a continuation up.
So my thesis and my plan revolved around watching and gauging the market around 60.40 was my level of interest. On top of 60.40 being a level where the market consolidated, pulling up the volume, we could see that there's a very large green bubble, which is a very large buying volume or trades hitting the offer directly at the 60.40 level. Now, as the market dips down into this 60.40 level, did not really see anything that indicated buyers were here, buyers were present, and buyers were strong to support this move up. Now, the market, as it's trying to rally out of this level, is when I formulate a plan to wait for this low to break at 60.36 and then reclaim above the 60.40 key level. So essentially is if this level breaks where the market put in this low, and then reclaim 60.40, I would then be interested in taking a long, targeting that high a day and targeting that 60.60 level that I mentioned that got developed from the CPI data. Now, another reason why I said this is because in this period from like 10:05 to even about 10:10 when the market consolidates here, in this quick 5-minute or so period, the market just was like a ping pong where it moved down, it moved up, it moved down, and it moved up.
And that's what we mean by consolidation. So it's consolidating in an area, meaning it's reversing back and forth and staying in this kind of rectangular box. I call it price action prison because it's like the price is trapped and it can't get out of that range.
When I see something like this, I view it, especially in this context, in an uptrend, that someone is looking to leverage into a position or build up a larger move. The market's compressing, that when it eventually breaks out, the breakout's going to be very violent and strong. And this is how I came up with my plan to long the market under this 60.36 level and then a reclaim of the 60.40 level. break under, reclaim, target that level of supply. So watch what happens here as the market breaks this level. This is just a simple liquidity sweep, a simple fake out shorts to make them attracted to this move down, and then the market rallies up, and I find enough confirmation to get long when the market breaks a level of support and reclaims it. It shows there's interest to the buyers and sellers are trapped here. So
another way of seeing that is also you have a double bottom, because you have a bottom here, right? The price went all the way down. And as soon as it got to this point here, it reversed up. You can see that with these 3 consecutive bull bars, okay? So we've got one bottom here, and then we're going to come down into that area where the prior bottom is, and you can see we made another bottom again, okay? So we've got a bottom here and a bottom here, making a double bottom as well as soon as we get this big green candle closing near its high.
At this moment, I'm comfortable getting long, reclaiming above the 60-40s, placing my stop loss under this green line, and then going for that target at the 60-60 level of supply. And we get the very strong rally up right into the 60-60 level, and I take my profits off the table there.
Awesome. So he entered here and he exited here near that prior high, which is a reasonable area to take your profits, okay? So following through here, the market analysis, as he said, he looked at that CPI data release at 8:30 a.m., which was a very aggressive bear bar that he pointed out to us, which again, Financial Juice is the place to go for those kind of things ahead of time, because you got to know they're coming ahead of time. And then he identified that range or consolidation area, and his trade setup was looking for a significant drop into that area. And then the plan was to look for a pullback to take the market long, targeting the 60-60 levels, which was near that prior high here, or actually just above that prior high into that area that he showed us previously. So that's the trade setup. And the execution and confirmation was the market consolidated around the 60-40 level, which was a key level of interest. He waited for a break of 60-36 and then a reclaim above 60-40 to get long, which we just pointed out to you. Another way of seeing that, in other words, the way I would see it is I would see that as a double bottom and then get in once we showed strong buying and confirmation of that. Now, here's your first sign of buying, because now once we have this green candle closing past its midpoint in the upper portion of the candle, you have a double bottom, because one bottom here, one bottom here. But then also you've got a micro double bottom with here and here. And once this candle closes near its high, notice we have accelerating momentum, because this was a decent sized bull bar. It only closed in the upper portion of the candle though. But look at this bull bar. This bull bar is significantly bigger than this bull bar. And this bull bar, not only is the bar body bigger, but it also closed almost at the top of the candle, which shows that the momentum is accelerating to the downside, which is a reason to take this baby up, okay? So that's a great entry there, a very reasonable entry for a long, and he took his profits up here, okay? So that's our first trade. Execution and confirmation, showing signs that the market was ready to rally and confirming it with the data on the chart. Now, notice we are not hoping, we are not guessing. There's nothing about this that involves guessing or hoping. We are using data like a professional trader, and we are doing what the data either confirms or does not confirm. And if we get the confirmation we're looking for, then we do what we're going to do. And if we don't get the confirmation, then we don't do it. That's trade one. Awesome. Nice work. Let's keep going.
Now, the reason why I explained my target first is because of my conviction in these levels when they form. I know how these levels act like sort of a magnetic force, or just somewhere the market tends to gravitate towards.
We call that support and resistance. And the best way to think of support and resistance is magnets, okay? They pull the price towards it, okay? Support and resistance are like magnets. It's the best way to think about it.
Now, if I had to be honest, I most likely, and it's hard for me to say after the fact because I did take this setup, it's hard for me to say if I would have taken this long if I did not have this important level of resistance there. If this level was not such a magnetic force to the market, I may not have been so inclined to take the market long down here. But it's just the simple break of 60-36 trap sellers. Now, Carmine, how do I know sellers are trapped? Well, all I have to do is look at the volume, right? The volume as 60-36 was breaking. This is the low here at 10:06, 10:07. Which from the candlestick chart, we could see the low here from 10:06, 10:07. As it broke, there was aggressive sellers, which is noted by the red bubbles or trades hitting the bid. filling and hitting a passive buyer, which is noted by the red and orange lines. So someone was selling into this move. This is a perfect liquidity sweep, perfect confirmation that sellers are trapped, and especially with all the green and the buying that came in directly after this sell-off under this liquidity sweep. And this is how I was able to have a $31,000 profit. Now, don't
Cha-ching.
compare numbers, compare risk and points allotted. My risk was around 2 or 3 points for a 20-point target. If you trade one ES contract, a 3-point risk is only $150. If you trade the micro E-mini contracts, which is what I recommend a lot of futures beginner traders to do, $3 or 3-point risk on a $5 per point risk is only $15 worth of risk for a $100 gain. Now on Thursday, February 13th was a $25,000 profit.
Okay, now let's get into trade number 2. So as you can see, we're using data to confirm or deny what we're trying to do. Let's get into trade number 2. The details of the trade, starting with, again, trading 30 ES contracts. He's going to show us how he clocked that $25,000 and gained 17 points of profit with a risk of 4,800 and maintained a 5-to-1 risk to reward ratio. Let's get to the market analysis.
Again, 30 ES contracts, but this time I gained 17 points worth of profit, $4,800 worth of risk, and it was a 5-to-1 risk to reward ratio, longing a dip and longing a pullback to target a level of supply and resistance.
Okay, not that different than the first trade. What you see is a move down into a support area here. You see a breakout out of that area. You see a pullback back into that area, and then strong confirmation of strong buying here. So that is a breakout pullback buy, right? Now notice we're looking for the same thing here, which was a breakout pullback buy. And it looks like he got long right here, okay? So when the market is trending, you can look at the overall pattern, okay, which is up. We can see that from here to here, we got an uptrend, right? We've got the lows getting higher and we've got the highs getting higher. That means up. Okay, good. But also if we zoom in, we can also see that the bigger pattern is made up of a lot of these smaller patterns, which are breakout, pullback, breakout, pullback, breakout, pullback, okay? So whether you get in after this breakout and pullback, and then this bull bar showing confirmation of a possible additional breakout here, or you wait for another one, pullback, breakout, and get in here, it's pretty much the same thing over and over and over again. And notice that the market will usually move in 2- and 3-legged moves. So if you get a move up and then another move up that's even stronger, it's possible and maybe even likely that that second move will trigger a third move.
Now let's go step by step on this analysis. The market on Thursday had PPI data. PPI data led the market to rally about 20 or so points. It was a little tame compared to the CPI data.
CPI, Consumer Price Index, PPI, I think it's Producer Price Index, I believe. And again, you'll see that on the Financial Juice website before the trading day so you can plan around it.
But similarly, we left an area where the market had very little or no volume transacted around 60.78 to about 60.71. This was an area where we had very little volume transacted here. Now this coincides with the PPI consolidation low, and I dragged it down to where the market was trading at prior to the PPI data at 8:30 a.m. Eastern time. So I like watching levels where the market was trading at prior to data or prior to news. They just serve as important levels of interest. Now, my plan in the morning was to look for the market to sell off into this 60.78 to 60.71 level, now that you understand where that came from, to play the market long, targeting a level of supply, which was at 61.01, and we're going to have that on my charts up here. 61.01 was a level of supply. I was looking to long the market at this level of, I guess you could say, support to target this level of supply. Now, the issue is the market aggressively sold off, and on this dip down, I did not see confirmation to take the market long. A lot of traders were asking, why did you not take the market long here despite it being in your plan? And the answer is, or they were asking, what did I see? And the answer is, I didn't see anything, and that gave me enough information that me not seeing anything was seeing everything, if you understand what I mean by that. So because I didn't see anything, that was what I needed to see to tell me to sit on my hands. Now I can't.
Again, what I want to do is underline the fact that he is not guessing, okay? He's looking for a specific setup. We've got that he had that PPI data that led to a rally, okay? Or he's looking for a rally, right? He's identifying an area that he wants to get in at. But then when it comes to the setup, he's planning to take the market long, right? But then the market starts aggressively selling off and he does not see confirmation to take the market long. So what do you do then? If you want to enter a trade long, but you don't see confirmation that the market is doing what you anticipate, well, then you should probably wait. Because if you're not waiting, then you're guessing. If what you want to see happen isn't being confirmed on at least a shorter time frame, and you don't have at least one, ideally two data points to confirm what it is that you are taking your position of, in this case, long, then you got to wait, because we're not guessing or hoping. We are using data to drive our decisions. And that's the difference between gambling and real trading.
Can't lie, I was sitting in FOMO a little bit because the market held this and bounced at it perfectly. There was no bids that filled down there. There was really no delta outliers. There was no absorption. There was really no strong selling activity. It was just a sharp, aggressive, violent sell-off to the downside and a very violent and aggressive rally and bounce from this level when the market held it perfectly. Now, the reason why I showed you the trade on Wednesday first was because there was a very similar volume pattern here when the market pulled back and held. So despite me missing this first rally, the market then pulled back around 9:47, which is this red candle, and then consolidated by about 5 minutes after this. Now, in this consolidation range, I was seeing the same volume patterns that I saw on February 12th at this 60.78 to 60.76 level. That if this 60.78 to 76 could now hold, I would be watching for an entry to take the market long. Now, unfortunately, I was a little too conservative. I was a little too trigger shy, didn't really see the best confirmation again there. And my issue with this day was I was being a little too conservative. I really wanted something to jump out at me so crystal clear, and it missed something because of my, I guess, bias or cloud of judgment that I missed this rally up, and then the market moves up higher. Now, at this point, similar to the trade on the 12th as well, we come 4 or 5 points shy of this level of supply. So I missed the earlier two long entries off of this, and the volume patterns that I saw here at the 60.78, 60.76s was similar to what I just mentioned on Wednesday. It was an up move, a down move, an up move, down move that we just consolidated for some time before eventually lifting off. The day prior, we saw the market break this level and then reclaim it for a long. On this day, again, me being too conservative, I guess I was going with the intention of the same setup. I really wanted the market to break this, hold it, and then reclaim it. Instead, all we did was rally up, and it never gave me a shot to enter that I was comfortable with. Now, despite the market being so close to hitting this level of supply, we now get a pullback shortly after missing that supply zone, and on a 1-minute chart, we can see a lower wick where the market was bouncing off of 60.80. Now, in this process of the aggressive sell-off, we could see it highlighted by the aggressive red bubbles or trades hitting the bid or aggressive selling. The market sold off and then rebound. This rebound after these red bubbles is why and how this lower wick formed on the 1-minute chart. Now, in this process of the rebound, the market left an area of low volume sitting here at 60.84 to 60.82. If you've watched my most recent video, I talk about this strategy on the low volume. It's an in-depth video on it. I would definitely recommend it. But now we have this level at 60.84 to 60.82 that if this holds, I could be interested in taking the market long.
Okay, again, he knows what he's looking for. This is the difference between buying and guessing. This is the difference between professionals and amateurs. They know what they're looking for, and they have the discipline, keyword here, discipline, to wait for that confirmation. So his decision not to enter was based on the absence of strong buying signals. So that's what we're trying to get at here. We want confirmation before entering. Now, the execution and the missed opportunities here are such. As he said, the market rallied after his missed entry, and it concentrated on volume patterns similar to the previous trade to identify his entry points. So he's pointing out that this looked similar to before. Now, why is that? Because the market has memory. That's why there's support and resistance, and that's why patterns work, because the markets have memory, and traders tend to do what traders were doing previously, meaning if there was buying in an area previously, it's reasonable to think that there will be buying there again. And accordingly, if they're selling in a certain area, it's reasonable to think that they'll be selling somewhere near there as well. So he missed the earlier opportunities due to being overly conservative. There's a little, he called it trigger shy. So there's some fear coming in, but then he noticed that there was another opportunity to get in with what he wanted. And that's good news for all traders. So if you're suffering for fear of missing out or FOMO, know that there will often be another later trade, and it will often be just as good, if not better. So the market dipped into the area that he wanted, which is around 60.84, and he found sufficient confirmation to get long. Okay. So again, you don't need to worry about missing out, because there will always, and I mean always, be another better trade. If not that day, then the day after.
Well, we dipped down perfectly into this 60.84 level, and I found good enough confirmation to try the market long at the 84s, going for the level of supply at the 01s. So it was about a 17-point reward for 3 points worth of risk, about a 5-to-1 risk to reward ratio. Now, the issue with this, and kind of why I jumped to the gun here, and I'm going to play this in real time, this is where I get confirmation. The area of low volume, right where my cursor's at, is being supported and is holding. So at this moment in this live replay setting, I'm comfortable enough taking an entry long with the stop loss under the low at this exact moment. And now really all I need to see to make this trade work out in my favor is large green bubbles or trades aggressively hitting the offer to come in. Now, the issue with this trade was I felt like because of the 2 trades that I missed prior to this, if I was a little too conservative, I may have missed this entry where I wanted to get long. The most ideal setup would have been a bounce off of 60.78 to 76s like I had mentioned earlier. But I felt like if I waited for the market to keep pulling back more, it may never get that pullback because I learned my lesson on the earlier 2 trades of me being a little too conservative. So it's kind of a double-edged sword. Yes, this trade worked, and yes, we rallied up into the supply zone, but maybe I was a little too risky with this, and I should have been a little more conservative. But because I was conservative in my previous 2 trades, I put a little more risk on here, not really waiting for the major level at the 78s or 76s to trigger. So I get long. Like I said, I was too conservative and I was missing entries earlier. The market sharply and aggressively pulls back into this, and then the supply level hit, and I got all out of that trade at the 6100s. And it was just simply off that analysis, simple and clean, longing sharp, aggressive pullbacks lower. It's been a common theme. And again, if you've watched my most recent YouTube video prior to this, I talk about this strategy. Sharp, aggressive pullback gets bought up. Sharp, aggressive pullback gets bought up. Sharp, aggressive pullback right here where I entered long gets bought up.
Now notice that this is a pullback entry, okay? And he's pointing it out over and over again. And yes, he aimed for that supply level at 6101 with the risk of 3 points for a reward of 17 points. In this case, clocking, literally tens of thousands of dollars, which is pretty awesome, okay? So he's noticed that he's being too conservative on the earlier trades. But then what's interesting is that allowed him to be more aggressive on the later trades. So that's one thing I want to outline here. The best traders know how to adjust. I'll say it again. The best traders know how to adjust. And this is one of the biggest differences between the less experienced traders and the more experienced traders. The more experienced traders, they don't get their panties in a bunch because they know that the market is always moving and there's always something that you can work with. So, in other words, it would have been better if he was more aggressive on the earlier trades. But then the fact that he was more conservative on those earlier trades allowed him to take more aggressive risk on the later trade. So it actually works out in his favor. And that shows to me his skillfulness in being able to adjust. The key word there is flexibility, emphasizing the importance of trusting volume patterns and market behavior. Now, I don't use volume patterns, but he does. And what does it matter? It doesn't. What matters is you trust the tools that you use and you go with those. I tend to utilize more price action. He is using a combination of different tools, but you want to just use what your tools do and leave it at that. Okay. And then, as you can see, he noted that the significance of the sharp aggressive pullbacks being bought up repeatedly. He's been trading this pattern and the pattern's been working. And let's be honest, pullbacks are maybe the best setup in all of trading, right? Because what you have is trading with the trend, waiting for re-entry, and then getting in for continuation of the trend, which is about as simple as it gets. And that's the take-home point here. Simplicity makes more money most of the time. Now, if you like this video and you're curious about my strategy, go to the link in the description or head to tradesbybren.com and I will share with you my 3 favorite trades, a downloadable PDF where I share with you those 3 patterns, the 3 setups I look for, including how I take my profits so I can get out before it's too late, and also how I limit my risk. In other words, how I set my profit targets. And if you like the video, hit that like button. And if you want to see more from me, hit subscribe. I'll see you in the next one. Thanks for watching.